Hello, I'm Shelly. Today I want to share a topic regarding to the Malaysia property ownership. So a few clients ask me if they want to buy a property, whether they should put under the individual name or company name. This video going to break down the personal and corporate ownership for property investor, highlighting the personal income tax and also the corporate income tax, RBGT difference, loan access, succession, limited liability protection, and also estate planning.
In Malaysia, property investment is a popular form of wealth accumulation among individuals and corporations alike. One of the most strategic decisions faced by investors is whether to hold property under their personal name or through a company structure. While there is no legal restriction on either approach, the tax treatment, financing flexibility, legal exposure, and long-term objectives vary significantly. This essay aims to compare the advantages and disadvantages of individual versus company ownership of property in Malaysia, with reference to tax efficiency, liability, compliance, and business strategy. 1. Tax treatment of rental income. Under individual ownership, rental income is subject to personal income tax rates, which range from 0% to 30%. Although limited deductions are allowed, for example loan interest, repairs, assessment tax, individuals may not claim for wider operating costs such as salaries or depreciation. By contrast, company-owned property is taxed at the corporate tax rate, 17% for the first 600,000 ringgit, 24% thereafter. However, companies enjoy broader deductibility for expenses including administrative costs, staff salaries, insurance, and maintenance fees. For large-scale property portfolios, this offers better tax optimization. 2. Real property gains tax. When a property is sold, RPGT is levied based on the holding period. Individuals benefit from more favorable RPGT treatment, especially for residential properties held longer than 5 years, where the tax rate may be 0%. Companies, on the other hand, are taxed at a flat RPGT rate, typically 10% for disposals after 5 years, and do not enjoy the once-in-a-lifetime exemption granted to individuals for disposing of a primary residence. 3. Financing and interest costs. Individual buyers typically enjoy lower interest rates and easier access to bank loans, especially for residential properties. This makes personal ownership more attractive for first-time investors or small landlords. In contrast, companies face stricter lending requirements and are often charged higher commercial rates. While this may limit leverage, companies may pool capital from shareholders or partners, enabling larger acquisitions. 4. Legal liability and risk exposure. Under personal ownership, the investor is personally liable for all debts and obligations. Any legal action or loan default can affect the individual's personal assets. Company ownership offers limited liability protection. In the event of legal claims or financial issues, only the company's assets are at risk, shielding the personal assets of the directors or shareholders. This is particularly advantageous for property-related businesses such as Airbnb operations or flipping. 5. Succession and ownership flexibility. Transferring personally held properties upon death may trigger stamp duty, RPGT, or legal disputes. In contrast, a company structure enables ownership through shareholding, which can be passed on, sold, or reorganized with relative ease. For investors planning estate succession or involving family members in joint ownership, companies provide better continuity and legal clarity. 6. Compliance and administrative costs. Individuals are not required to maintain audited accounts or submit company filings. Their annual reporting obligations are limited to personal tax returns. Companies must comply with statutory requirements such as annual audit, tax filing, and SSM compliance. These obligations involve additional costs, 3,000 to 5,000 ringgit annually, and professional engagement, which may not be cost-effective for small-scale investors. Summary: individual ownership is generally more suitable for small-scale investors seeking simplicity, lower financing costs, and favorable RPGT treatment. In contrast, company ownership is more advantageous for large-scale portfolios, joint ventures, or those seeking tax optimization, asset protection, and long-term succession planning. The choice between individual and company ownership should be based on investment size, business goals, risk appetite, and administrative capacity. A well-structured approach can significantly improve tax efficiency, protect wealth, and enhance strategic flexibility in Malaysia's dynamic property market.
So this is the video that I'm going to share today. I hope you like it. Thank you for watching.